From its beaches to its beautiful backwaters, the state of Kerala's retail, real estate, IT and infrastructure sectors have flourished. And I'm here at the Leaders of Tomorrow's Springboard in the city of Trivandrum to understand what makes this city tick.
In the first segment, we have Kavin KK, Managing Partner, Startup Banking, IDFC FIRST Bank. And in the second segment, we're joined by Vijayakumar R, Financial Planner, Echo Wealth.
First of all, I think it's absolutely brilliant to see a packed hall. I think it's looking fantastic from out here. I feel privileged to be able to, address such an august gathering of all the business leaders of Thiruvananthapuram. I will just take a couple of minutes, maybe introduce a little bit about IDFC FIRST Bank and specifically our startup banking proposition for all of you. IDFC FIRST Bank was actually formed in December 2018 by the merger of IDFC Bank and Capital First. Very, very happy to share with all of you that today it is among the top 10 banks in the country by market capitalization. So in a very, very short time, it's really scaled thanks to the support of customers like you. We, at a bank level, have more than 1.5 lakh crores of customer deposits, grew by 44% last quarter. And the reason is the support of customers like you who've really been through us with the thick and thin. As a bank, we always call ourselves a startup bank. Why a startup? What is a startup? A startup is someone who's challenging the status quo, who's trying to disrupt, right? And we have always been disrupting. When we came in, we were probably one of the 50th bank on the street. There was no reason for somebody to bank with us unless we brought something different to the table. So we've got probably the most innovative suite of products across all banks. On your current account, today you can earn up to 7.5%. This is a dated ad. Most of you would have seen it in the major newspapers across the country. You can earn up to 7.5% on your current accounts, which normally earn you 0. Some of the newspaper headlines, we are the first bank to come out with a recon account on ONDC. ONDC is actually a great example of the public rails provided by the government, which can enable businesses. As a business, you cannot afford to ignore ONDC, and we are probably the only bank today which is providing the recon on ONDC accounts. We've got CBDC, the government initiative on the digital currency. Today you can make payments using that. Another new initiative which is very, very interesting is UPI. So we are having the G20. The residents of G20 can actually make UPI payments even though they are from overseas. We've got probably the most exciting proposition on saving accounts, zero fee banking. You earn interest up to 7% and 0 fees. You've got the sticker-based debit cards. I think very, very innovative payment method. NASSCOM COE partnership to encourage startups. Now, all these initiatives have actually helped us deliver our best ever profits. We did well over 750 crores of profit last quarter. So annualized, that's more than 3,000 crores. Some of the innovations that we bring to the table. As a bank, we have a philosophy of partnership. So we took a call that we don't want to be earning on fees and charges. So almost 28 different fees on saving account, almost 50 plus fees on current accounts that we decided we will not be charging our customers. We provide free doorstep banking to every customer. So the idea being that you don't need to travel to the branch. There is a doorstep banking facility available right from day one without any cost. Every account is managed by a separate relationship manager. So something very, very interesting. As a bank, Something that we realized is everyone who has a loan today pays an EMI. Every month he's making a payment to the bank. But every bank pays their interest quarterly. We thought that's not fair. So we said that we will become the first bank. It was not industry practice, but we became the first bank to start paying monthly interest. So the thought process always has been to try to see what's right for the customer, what's best for the customer. Since we have such an august gathering of some of the top founders and ecosystem partners here, I can't not talk about the startup ecosystem in India. I think startups today have changed the way that everything we do functions. When you're thinking of food, you're ordering from one of the apps. If you want to commute, you're ordering on an app. Everything, the way that everything happens today has changed significantly. Our way of life has changed completely with startups. India today is right at the epicenter of the global ecosystem, third largest startup ecosystem, almost 1 lakh startups in the country. And Kerala, with almost 5,000, is right up there. I think some of the innovative work happening is fabulous, especially Technopark, I have to call out, has been super supportive, Kerala Startup Mission. The ecosystem is so very vibrant here. Trivandrum, I think, beautiful city, Thiruvananthapuram, is home to more than 3,500 startups. Incidentally, Vijay sir is here. He, as all of you know, is ex-CEO of Technopark. Technopark was actually the first tech park in the country, in the whole of India, well before the Infosys and the others came out in Bangalore, the first tech park in the country. I'm told more than 70,000 employees, more than 450 companies. I think it's a beautiful example of the kind of companies coming out of Kerala. Some of the standout names, some of them you would know. These are some of the funded companies from Trivandrum. Since we are talking about startups, I have to cover something about what we do for startups. Like I mentioned, when we come into a segment, we always think about what are the problems that the customer has and try to solve for those. So when we spoke to startup founders before launching our program, we asked them what were their pain points. They spoke about how they wanted simplicity in banking. So we essentially made our startup current account zero balance, meaning you get the top end of facilities, the best of facilities, without having any kind of a balance commitment requirement. So when you're building out, you're not worried about your bank. And the facilities are things like free doorstep banking, no transaction charges on most facilities. So NEFT, RTGS, IMPS, which some of the other banks may be charging for, you get it free of cost. You get, your import-export transaction charges are waived off. There's a whole host of, you can use your, booster facility to start earning on the balances in your account. The second, very, very important solution for startups is technology. If you look at Amazon, a Flipkart, an Ola, a Cred, a Nether, the one bank which works with all of them is IDFC. We may not be the biggest bank, but because our tech stack is one of the most robust, we work with all of these players. We facilitate a lot of banking partnerships. A lot of our service delivery is basis the support from startups who have the most innovative kind of solutions. Everything is on a digital platform. Everything that you do is pretty much, digitally enabled. You don't, like, if you ever happen to drop by a branch in Thiruvananthapuram, you will hardly see customers. It's a very, very large branch, but you would hardly see people. In fact, even in our largest of branches with thousands of crores of deposits, you would not see people crowding because everything is digital. The only reason we like you coming down is for having a coffee. There's almost all your transactions can be done online. We've got another very useful solution for startups, which is the corporate credit card. A lot of startups tend to use the founder's card, which leads to a lot of issues. So we came in very early with a corporate credit card. The booster account that I spoke about, where on your excess balances you can start earning, which was otherwise not generating any kind of returns for a businessman. We also have multiple, I think if I keep at it, there is too much to cover. I don't want to spend so much of time on one slide, but there's a fantastic startup proposition. A lot of my colleagues are here. If anything that you find interesting here, please reach out to them. I thank you for being such a patient audience. Thank you so much for your time.
It's time for a short break, but our coverage of the Leaders of Tomorrow Springboard in the city of Trivandrum continues on the other side. We'll be right back. Welcome back to our continued coverage of the Leaders of Tomorrow Springboard in the city of Trivandrum. We're here to bring you all the highlights. Have a look.
There is no one-size-fits-all formula to securing your financial future, but it oftentimes benefits to learn from the wisdom of others. So keeping that spirit in mind, if I could now please invite on stage our very special guest. Please join me in welcoming financial planner with Eco Wealth. Please put your hands together for Mr. Vijayakumar R. Huge round of applause. There is a lot of discomfort that surrounds discussing your financial planning, even amongst the immediate circle of your friends and family, right? People that you can supposedly trust. And that also leads to huge gender imbalance in terms of who's the decision maker within the household when it comes to matters of finance, right? So what do you suggest is the first step towards chipping away at this hesitation?
Again, it is, I think these are things more to do with the way we upbring our children, maybe our own upbringing, the culture, in other words. A lot of changes to be made there. For example, nobody teaches financial planning as a subject in the school or any curriculum for that matter, not even in your colleges. So isn't it so basic and a fundamental thing to know about managing your own personal finances? And ultimately, who has to make that call? It is you yourself who is the owner, or probably sit together as a family and then do it for a family if it is a family unit which we are discussing about. But the point is, these need to be imbibed as a culture. Maybe when you're having that dinner next time, with your children, open up topics of interest. I mean, make it interesting for them to, get an interest into. Maybe you can, inject this by allocating, some pocket money, some allowances for them to start with, and the way they can actually save from whatever are their allowances, and give them an experience of making them invest, and then show how investments can in the long term create returns, and how the returns can, that itself will create a positive loop.
So that's one approach. One approach is certainly experience it for yourself, all right? And then the other approach is learning from the mistakes of those who surround you, all right? So many times you'll see families in situations where it's unclear after the passing of a family member, after a death in the family, who the nominee is, what the passwords are, how the accounts are to be accessed, right? Who's a part of the will, what are next steps in terms of painting that sound financial picture for the next generation, right? And oftentimes the hesitation is exactly what gets in the way of establishing and creating this clarity. So, what are some of the most commonly made mistakes in your view that people need to keep in mind with respect to sorting and staying on top of personal finance?
Very good question again, Pooja, because, like you said, with each passing day, the kind of complexity revolving around personal finance is getting more and more, thanks to all this product engineering and a lot of new, investment products being launched, and a lot of things, a lot of developments. So there's all probability you will get yourself lost in the tantrum which you've got yourself into with a lot of different investments and your assets being distributed widely and dispersed over a different sort of investment avenues. So it's always a good idea to, number one, to have a financial planner who collates. So, for example, I am a financial planner here. So what I do, I sit with my clients, understand what are those financial objectives which they've got for themselves. It could be long-term, short-term, medium-term, could be anything. List out those goals. Now, also, I ensure that I list out all those assets, all those liabilities, all those different asset classes which they've got themselves into, all the data, preferably on one single venue. It could be, I do it online. I take the help of technology to do that. It could be offline too, but either way, make sure that your family is in the know-how of where this information is, that the information is key. And of course, then when we talk about things like having the denomination or the beneficiary added, that's a good start. But ultimately, the nominee is not the ultimate beneficiary. So you have to define those in your estate planning, basically. So estate planning could be as good as, it could be as simple as a will which is being drafted, or it could be into complex structures like your, retirement, your trusts, formations, and all that.
Well, you bring up a financial planner, and one common concern is at what age and stage in your life cycle does it even make sense to approach a financial planner, right? Do you do so as a first-time jobber? Do you do so once you've, entered a marriage, a union of some sort, had a child, or as and when you're looking to pursue a career switch, or down the line, pursue retirement, right? It can be extremely confusing, and one often thinks, I just simply haven't saved enough to the point where I require the hand-holding of an expert. So how do you guide someone who finds himself in that situation?
In my experience, I've come across clients coming at different stages of their life. Some who has just, I had a client calling me yesterday, a potential client, I would say, who just got the offer letter for her first assignment, out of her education, out of her college, she's getting into her first assignment. So I have such proactive people who want to do this proactively right from the beginning of their, even before they have started earning their first month's salary, to people who have retired and people who never knew about, this kind of, because to be honest, my kind of a profession is very, very novice in India. Hardly people know about, financial planners even today. People may be aware of chartered accountants, but they are quite not aware of certified financial planners probably in India even today. So it's a very, very new industry, and so many of them they're not aware that there is such a service which can be availed. So I do get to interact with all such people who are who are in the different stages of their life. Yeah. But to answer your question precisely, the best time to start with this is the moment you realize that there is such an opportunity available for you to employ a professional to help you out with your personal finances. And ideally, this should be done from the moment you start earning. Because, once you start earning, what happens is we pick a certain lifestyle. There's a certain cost attached to these lifestyles. And, why do we plan? Essentially, we plan for us to maintain these lifestyles, going forward also, even post-retirement, because we can't be, keeping earning all the time. But even post-retirement, we should be in a position so as to, enjoy those certain lifestyles which we have picked. And it's really hard, believe me, to shed those, those extra few things which you enjoy with your, money. So ideally, you should plan for those.
All right. And Mr. Vijayakumar, we have a lot of budding entrepreneurs in the room. We also have a lot of established entrepreneurs in the room. And sometimes there is a tendency to blur the lines between personal cash flow and corporate cash flow, right? Especially if you're an individual proprietor or part of a family-owned and operated business, for example, right? How might you suggest someone navigate that challenge?
Again, very pertinent, I would say, because a lot of such cases where we see, especially those proprietorship firms, where you hardly differentiate between the owner of the business and the business itself. It's really a thin line they're threading between, managing the personal cash flows and the business cash flows. But ideally, yes, not ideally, I would say mandatorily so. You should be splitting these two separately. The business cash flows should be kept separate from your own personal cash flows. And when we are at this subject, I would also mention this, this anomaly, I would say, which I'm observing most of the times, wherein a business owner, especially somebody who is young and who just started running the firm and who might be into the 5th year or 6th year, or maybe even before, of running the business. So many of them, they don't try to figure in or put a value for their own time and effort in the business, or they don't draw salaries for themselves, which are all, I would say, those are the beginnings of the reasons why these lines are getting blurred to start with. What we recommend usually is that you won't be able to even evaluate your business's expenses until and unless you are drawing a salary, you are putting a value for your own time and effort. Because if you have not incorporated that expenses under the expense header, then how do you get your math right?
I completely agree. And by way of my closing comments and last question to you, Mr. Vijayakumar, you've essentially guided hundreds of clients, right, on their personal finance journeys. What do you consider to be the most commonly made mistake or the regret statement that you've heard most often that we can benefit from so as to not make that mistake in our own journeys?
Easily the most heard is that I should have done this maybe 10 years before. I should have started investing, because the moment people realize it is not only money which is doing the magic, more importantly, it's the time which brings the magic to the table. Without compounding, there is no charm in whatever is this investment. And by the way, that's one of the major differences between savings and investing. Saving doesn't compound, investment compound. And that's one huge difference between savings and investing. Saving is, simply put, savings is you draw a fixed or variable sum of it towards income, and then you meet your expenses, and whatever is left is your savings. But investment, I would put it in a different way. Investments are for you to meet your objectives which you have set for yourself. It could be the expansion of your business. It could be putting your children to the schools or colleges. It could be for your own retirement kitty. The goals, the objectives could be anything. But you define your own objectives, and you start to figure out how much I need today to save and invest again, because investment comes with compounding, you see. So investment at a predetermined rate, that again depends on what are your objectives. If your objectives are long-term, and if you're into equities, probably it is safe to assume a post-tax real return of about 10% today in our country. If it is something more into debt or fixed income oriented, safe to assume it is 6%. Products like gold, commodities, on an average, they have, including real estate, on an average, they have delivered about 8% on a decade-wise, if you look at for the last decade and before that, and so on. So we have a fair good idea how much is going to be the compounding, and with that working in mind, what I can do is, actually I can change the formula to, my earnings minus my savings is going to be my expenses. That's the only way actually we can achieve those goals.
Thank you so much once again,
Thank
sir.
you.
We really appreciate it. I'm Pooja Jain signing off from the Leaders of Tomorrow Springboard in the city of Trivandrum. We'll see you next time.